welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on commodities, and my guest is Jim Scheinberg, the founder and managing partner of Pier Search Consulting. Commodities are a unique asset class in that they reflect supply and demand in the real economy as it stands right now. From this perspective, it should be a one-way bet. The global economy is ramping up for a recovery unlike any other. One of the most tracked commodities indexes is this one, the S&P Goldman Sachs Commodities Index. It's up 28% this year, so far outperforming the wider market. Half of the value of this production-weighted index is made up of energy futures, including crude oil and gasoline. But as you can see, this sector is varied. It also includes everything from agricultural commodities such as wheat and soy, to livestock, to industrial metals such as copper, as well as gold and silver. So, how should an investor approach this space? Let's ask Jim Scheinberg of Pier Search Consulting. Hello, Jim. Thanks for joining us. I know a lot of institutional investors seem quite bullish on commodities right now. So why do you think that is?
Well, for starters, it's because they have a long-term base case for commodities in their long-term strategic plan. The reason that this is getting more attention these days is because a lot of the retail investors and the more fluid investors somewhat abandoned what would have been a longer term commodity viewpoint back if you go back 10, 15, 20 years, just because the last decade has been so choppy and non-directional. So the institutions are there, just to remind you, not necessarily solely based on a return assumption and trying to increase their net results on their total portfolio. Commodities have always been looked at by the institutions as a natural hedge for things along the lines of their fixed income portfolios and rising rates. So that's the beginning of the discussion. But that said, in the OCIO space, the outsourced chief investment officers that are allocating for these institutions, they are making a bullish case right now. And a lot of those particular opinions have a lot to do with the recovery from COVID, as well as some constriction in terms of supplies as well.
But let's break this down. All commodities are not the same, are they?
No, absolutely not. You have some that are much more susceptible to things like weather patterns. And so when you get into the world of crops, it's a very different story. Those that are attributed to cyclical areas of the economy and cyclical cycles of the economy, those are going to be much more susceptible to directional swings.
And let's talk about industrial metals like copper and iron ore, for which, of course, the biggest consumer is China, where the government at the moment is trying to manipulate those prices downward. So what is the impact of that on the market?
Well, specific to copper, a lot of the mining actually comes out of copper and specifically Mongolia. So they do have some influence over that market. But you have to look at those metals, particularly compared to things along the lines of oil and natural gas. In oil and natural gas, there are spigots that you can dial up or back. You can increase the National Petroleum Reserve if you want to increase demand. There are tanks to be filled or drained. But with mining, to basically get deeper into the ground, if you really end up with shortages, it's far more difficult to lever up and lever down supply. So really with China, because China was a natural buyer of those same materials, really they're trying to control, and their ability to control is largely just attributed to their appetite in the marketplace. But you have to look at the infrastructure, that spending that's going on across the globe, to understand that they're not the only player in the space, and they may not be able to impact those markets as well as they want.
Overall, though, the prices of commodities like metals are generally very high at the moment. How much of that is down to temporary supply-demand problems that were mostly caused by the pandemic and therefore liable to a correction?
Well, that's the big dilemma, and certainly the debate that goes on right now inside the OCIO community. We were hearing discussions about the bull case for commodities as a whole, but basically these basic material areas, specifically when we were into the summer and fall of last year. Now that we've had sharp revisions in price to the upside, we've definitely seen a little bit more of a debate ensue. You have one camp that we're hearing recently, and this really trickles back into the inflation trade as well, that says that we're going through a knee-jerk increase in inflation and commodities prices. And once demand normalizes globally, things will start to normalize in terms of pricing, whether that means that they start to trade more sideways or range bound, or they retreat further from their peaks. That's the question on that side. But on the other side of things, you definitely have a case that the emerging market consumer and middle class that we're seeing booming, especially in Asia, the fact that we have massive infrastructure investments going on across the globe, especially here in the United States, a lot of headlines around that specific to today, that these base metals actually go into the things that we're going to be making a lot of for a decade to come. And when you look at things like copper, for those of you who remember, there was a whole argument 15 years ago about peak oil. Well, that never happened. We found a lot more oil. Copper is a different story. You can't go deeper into the ocean. Copper is a very difficult material to mine and resource. And as you go deeper, you create more environmental impacts, and it's much harder to excavate out of the ground. And there is a true belief that we are going to end up outpacing supply with demand very soon if we're not already there.
That was Jim Scheinberg, the founder and managing partner of North Pier Search Consulting. Well, before I go, here are some of the top stories in the sector. Russia is preparing new export taxes for steel, nickel, aluminium and copper that will cost producers about $2.3 billion between August and December this year. Moscow is putting the taxes in place to try to protect its defence and construction industries from the rising costs of raw materials. A senior minister told a government meeting that the temporary taxes will allow the government to prepare a more permanent mechanism profiting from the commodities boom. Iran says the United States had agreed to remove all sanctions on Iranian oil and shipping, but Washington said, quote, "Nothing is agreed until everything is agreed," in talks to revive the Iranian nuclear deal. The remarks were made by the chief of staff of Iran's outgoing president Hassan Rouhani and reveal Washington may have been ready to make major concessions. The indirect talks to revive the 2015 deal were suspended on Sunday for consultations after hardliner Ibrahim Raisi was elected to replace Rouhani from August. And China has released details of its first round of auctions of metals from its state reserves that it hopes will keep a lid on prices. However, initial market reaction was underwhelming, with copper prices rising in London this week. China's National Food and Strategic Reserves Administration said it will auction 20,000 tonnes of copper, 30,000 tonnes of zinc and 50,000 tonnes of aluminium on the 5th and 6th of July. However, the amount of copper being sold is just 2.3% of China's output of the metal in May alone. For zinc, it's 5.7%, and for aluminium, it's just 1.5%. Although analysts say the auction could be an opening shot in what could be a long battle. And that's your roundup of the commodities space. I'm Elena Casas, and this is Reuters.